For a successful trading process, you basically need these 3 to 4 things. You need your context, which is your trading idea, what your entire framework is based on. Then you need a location where you want to get those entries, a level like a fair value gap, a volume profile level, whatever it is. And then you need an entry trigger to actually press the button and get into the trade. To optimize the performance and the win rate of your model, you will probably add confirmation or invalidation in this process. For a successful trading process, you basically need these 3 to 4 things. You need your context, which is your trading idea, what your entire framework is based on. You need a location where you want to find those entries. This could be a volume profile level, your fair value gap, whatever it is. And then you need an entry trigger. This tells you when you actually are allowed to press the button to get into a trade. To optimize your model, you would probably add confirmation and invalidations in this process to filter out bad trades and increase your win rate. I think classic charting techniques on candlestick charts like ICT concepts are only useful for one of these 4 things, and I will show you why and how to make the switch the right way. So I want to show you why classic charting techniques can work and why volume analysis is still so much better by comparing context ideas, so classic smart money concepts, to the auction market theory framework, which just explains how buyers and sellers agree or don't agree on prices and how the auction, the market, moves. So the first very popular concept I want to go over are fair value gaps. So the theory behind a fair value gap is just that we move through an area very fast and we leave behind a gap, inefficiency, where price didn't spend a lot of time and couldn't build a lot of volume. The same concept existed many years earlier with auction market theory and just market profiling as well as volume profiles that just measures where market participants agree on value and where they don't. And here you can see what actually happens here. So we have an area where we consolidate and buyers and sellers agree on that value. Buyers and sellers always need to agree on one price to get a transaction and to move the market. If buyers and sellers don't agree on value, which means for the buyers the price is too high or for the sellers the price is too low, then price needs to move. And if we see those moves because something changes, information changes, or one participant isn't happy anymore, we will see price shift into the next balance. This is something that we call price discovery. Now, if we leave a low volume node in here, then we can't get a lot of transactions here. And all of the institutions that have to fill their orders know that they can't get filled in this area because there is so little volume and no one takes their big orders. Which means that we can assume that if price pulls back to this area, it will either reject fast and accept the lower balance again, or it will break through fast and accept the higher balance again. If we accept into a range, we are always assuming that we will slowly work through that range, work through all of this liquidity and get everyone filled. And this is exactly why inverse fair value gaps can work, but it is still a lot better to just use a volume profile because you actually don't know where the balance starts, if it is a clean balance, where the low volume node sits, and if it is a valid trade. I also would really suggest you that you use order flow with it, because otherwise the only judgeable thing is the candle closure on a candlestick chart, which can just happen randomly because the candle closes up there or is up there at closing time. The biggest problem is probably just that you're just gambling on this. Not always when we see this formation we actually have a low volume node. It is so much less precise than just a low volume node, and it leaves a very, very big room. What you can see here is that we have a room for this from here and all the way actually up to here, because we don't see a candle closure, and all of this is a range too short for us, which is extremely huge, and more precise ranges offer bigger trades with less risk. What I want to explain you now is weak and strong highs, which is actually a valid concept that I also use, but with market profiling it makes a lot more sense, and I want to show you why. What we can see here is a classic liquidity sweep. We swept this high, pulled back into the range, and when we pull back into the range, we are expecting the low to get taken out. Why is that the case? Pretty simple, because this high was weaker. Now we took out that high. It isn't too strong because we still have more volume up here because of those two highs. But in market profiling, we call something like this excess. It just means that we pushed away from a high or a low swing point very fast, which means that strong hands push the market. What we call a weak high is when we have very weak hands pushing the market from a swing high or from a swing low, and we will see very, very slow price action that slowly drifts price in one direction and leaves a lot of highs and lows. So why do we expect this entire rotation if we re-accept the range? Pretty simple. We tested prices outside. We could not agree on fair value. Now we are back in here where a lot of transactions have taken place. And now we are expecting all of this liquidity to get taken because buyers and sellers agree on these prices. So everyone is happy and we can exchange assets. You can see the same thing in here. This would also be a balanced area, a very clean balanced area. So what we would expect right there is a rotation from up here, the value area high of this range, to the value area low of this range with a very clean bell curve. Now, if we move lower and we decide to get back into this range, what we expect again, we would expect a fast rotation through that range, and we would target, first of all, these highs. Probably would expect a pullback here because we have all of this untouched weak highs. We have this low volume node at a value area high above this balance where suddenly buyers and sellers do not agree on value that much anymore. So we will probably get a pullback first and then decide if we want to break out, accept this range again, or if we want to see a rotation lower again. For the next concepts, we will just stay at this picture. It is premium and discount or a fib, whatever it is that you draw to get a 0.5 level or a 0.63 level, whatever it is, to measure where discount and premium lies. So where you have cheap and where you have expensive prices. But why should we measure this by price distance? If we could just measure what buyers and sellers actually agree on and what was too expensive and too cheap for someone in the past. And this is what a volume profile and its value area high and value area low is for. This is the first standard deviation. This comes from the classic bell curve, where you can see the first standard deviation, which includes about 68.27% of the entire volume. To draw this, we need a range, at least in my opinion. A lot of people don't do it this way, but I think we need a range to measure this correctly. We can't just put it on any price lag and use value area high and value area low. But in this case, you can see that these are very, very significant levels. You can see that at the value area high, volume really drops off and people aren't interested to exchange the NQ in this case right there. So this is why this is a expensive price if we keep accepting this balance. As well as this value area low is a cheap price because you can see how volume gets less down there. So unless something shifts and we see a breakout at these value area highs and value area lows, we are expecting them to act as support and resistance. So if this caught your interest and you want to start trading with volume profile analysis and order flow, then I would highly suggest you to join the Discord server. It is completely free and you will find a lot of education, as well as my TikTok channel where I post slides to break down my trades to see how you can apply this for yourself. If you want to start charting, you will find my entire setup completely for free in the Discord server. And if you have any questions, please just comment or write on Discord. Have a good day and see you in the next one.